Do you know what the top 7 retirement planning mistakes are? Well, look, I'm going to be telling you the most common ones I see time and time again, which have a material impact on the ability for those to retire when they choose to, crucially avoid running out of money in retirement. And while I expect for many of you, some you will already be considering these carefully, but I bet there are some here that will give you pause for thought. Anyway, if you haven't caught my videos before, my name's George. I'm a chartered financial planner and retirement planning specialist. I've helped thousands of people retire without worry. So let's dive in. The first big mistake I see that people apply to retirement is the risk which is like carbon monoxide to your wealth and your long-term security. You can't smell it, you can't see it, but we need to internalize that inflation, or more accurately, the compounded impact of inflation, is the big risk in retirement. The worst thing about inflation is that if we don't consider it fully, then by the time you realize its impact, it'll be way later into retirement when you normally won't be able to earn. So you're unlikely to be able to do anything active about it and to counteract it. For this reason, the planning for inflation across retirement has to start now. If we consider the data, the average inflation rate since 1993 has been 3.4%. That means over a 30-year period, it costs 3 times as much for the same goods. If we look back to 1973, then the annualized inflation rate is 5.7, which means that you would need £17 today to make a single pound of purchase back in 1973. Inflation, I think, is one of the hardest things to understand because we as humans just aren't really made to understand compounding returns. Kind of like the scene in Austin Powers where Dr. Evil can't understand how much to hold the world to ransom.
For $1 million.
Well, don't you think we should maybe ask for more than $1 million? $1 million isn't exactly a lot of money these days. Virtucon alone makes over $9 billion a year.
Really? It's a lot.
You don't want to be Dr. Evil in your retirement plan, do you? So it is, as I said, it's the compounded impact of this that makes all the difference. So we need to have a good look at all of our assets and understand which are going to be impacted by inflation. Now, under the current legislation, the state pension is protected by the triple lock, which is the highest of CPI, earnings, and 2.5% each year. So currently that offers a really good level of inflation protection. You may also have defined benefit schemes which are due to come into payment. And if that's the case, then you need to make sure you check how much of these increase with inflation. The whole thing may just be CPI or consumer prices index, kind of like the NHS scheme, or perhaps RPI up to maybe a maximum of 5%. That's quite common. But you do need to double check it because some defined benefit schemes don't have increases on certain tranches of the benefits. Typically, benefits built up before 1997 could be ones to watch out for because there wasn't a statutory increase in payment required for what was called the excess benefits. And this is where we're going to get technical. If you've got a defined benefit scheme, there are 3 inflation periods to be aware of: in service, deferment, and retirement. As in service, you're working, you're still active; deferment, you've left but you've not taken your pension; and in payment, you have retired. Now, these may all be at the same inflation rates, but I know from experience these in truth can all differ. So there really is no other way apart from checking the position on your scheme. There is complexity here, but it's one of the reasons I'm in a job. So number 1 is underestimating inflation. Okay, the next one tends to be the one that I tend to get more from the men in the family. And there's been a lot of times where I'm discussing retirement planning and a client will be adamant going, "Oh, I won't get past 78. And normally it might be because of family history or maybe just a perception of their health. And this is a tricky one because the bottom line is nobody knows how long we're all going to live. But the job of planning is trying to get the balance right between overspending and underspending. Where perfect planning, it could be argued, is dying with £0 in the bank account, a real die with zero attempt. Although this is very personal and many people want to leave a meaningful legacy to the kids or the families or maybe to charitable causes. At the end of the day, as a planner, my job is to make sure I guide my clients to a position where they have dignity and independence in retirement. So we do, for that reason, have to make sure we err on the side of caution while being reasonable, because the last thing we want to do is put you in a position where your ability to earn is gone, but you need more money. And we have to be mindful of the unknowns that are going to come our way, maybe extra costs for home adaptations, home maintenance, care. So a couple retiring at 65, there's a 51% chance that one of those individuals will hit 90. Now, there's also got to factor in a 30-year potential medical advances and improvements, which could also extend longevity. I'm not saying here that I have a crystal ball, no one does, but I'm yet to have a client who feels comfortable spending heavily as their assets deplete close to zero. So number 2 is underestimating how long you will live. Okay, so the next one is from the US finance guru, a guy called Dave Ramsey. Here, let's see what he says.
It ought to be more than that. I mean, if you're making 12 in good mutual funds, and the S&P has averaged 11.8. And if inflation for the last 80 years has averaged 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8.
So the key relationship with cash flow planning is the relationship between inflation assumptions and growth expectations. Of course, if you are reliant on investment growth to fund your retirement, which most people are, it's really important that we don't over-egg our growth rate assumptions. There is no point assuming 10% growth each year after inflation because there's no historical basis for that. You know, I often do see the touted S&P that gets 10% a year, but the thing I would say is that you only get one retirement, so making a big mistake on an assumption is not something you want to do. Markets and investment periods are cyclical, especially if you take concentrated positions. From 2000 to 2010, the S&P 500 went nowhere. So just to show you this chart where it shows that. Now, going over the long-term data from UBS, you can see the long-term inflation-adjusted returns of assets over different times, with the US, which is one of the best performing developed markets, from 1900 to 2023 showing 6.5% annual. That's after adjusting for inflation but no fees. And in fact, most periods are around the 6.5%. Now, if we exclude the US and go world excluding US, it's about 4.3 real after adjusting for inflation, 3.8 and 4.3 depending on what period you're looking at. So obviously US has been fantastic for the last 50 or so years. Will it continue? We don't know. But the point is that if we're assuming way too high performance, then we could be in for a shock in later retirement. So number 3 is overestimating growth rates. Hey, just super quickly, my colleague, also called George, no, you're confusing, is running a webinar audition where he's speaking with a client who has recently considered consolidating the pension, and they go over pros and cons. If you're interested, I'll put a link in the description. So often I'll get asked by clients, I'm about to retire, should I just de-risk my portfolio? As in move to cash or to really low risk investments? And my answer is always, well, no, because just because you've turned 60 and retired doesn't mean that you have a short-term time horizon. You may be requiring growth to fund your life. That money might need to grow and last for another 25, maybe 40 years. So we don't want to be in assets that aren't going to grow if you need it, unless it's a completely conscious decision and you just don't need any growth to achieve your aims, which is what a cash flow plan will show you. The truth is, de-risking your portfolio, you will reduce future expected returns. So we need to give that money a chance to grow and keep pace with inflation, ideally outstrip it. And we have to do this while counterbalancing another retirement risk, which is called sequence risk, where the impact of investment returns have a big impact on how long the fund lasts. This is why it's really important to understand what distributions are going to come from what pots in the early stage, and the impact of if a market does pull back. I'll show you a simple example from Morningstar. It starts with $1 million portfolio. See the impact on how long the funds last. Now, I fully appreciate saying that a higher equity content portfolio will likely grow more and lead to the biggest retirement pot almost sounds too simple to need saying, but I found that sometimes just walking through with clients the consequences and the impact of the decisions here has a big impact on, you know, getting their frame of reference right for what they're thinking. But if you opt for more equity content, there's a trade-off. You will experience higher volatility over your retirement. That has a cost, albeit mainly an emotional one. But when often we're looking at the plan, it's about, okay, are we on track for the goals? You're going to get more volatility, but money is freedom and choice at the end of the day. And I think it's incumbent on a planner to make sure that someone's lifestyle can be maintained as much as possible in retirement. So number 4, a hidden risk, is investing too cautiously. Okay, next, so one part of the discovery process when I'm planning for clients is making sure I truly understand what a good lifestyle looks like to them. What that means, of course, of going over expenditure, considering the costs that they consider as part of their life. And within the mixture of that, there is core needs, there's kind of keeping the lights on, there's discretionary, things you'd cut back on, and then lifestyle, so that's things you'd like to spend on. Now, that will give us a good idea of your kind of ideal spending, but we need to be mindful of leaving some space for unknown costs. Just think about the last 5 years. I bet there will have been costs for you that came up that you just didn't expect. Maybe it was a home repair, maybe it was the kids, maybe the boiler just went out of warranty and then broke. You know, it happens. The reality is, it's naive of us to think that in retirement some of these things won't happen. We really need to ensure that within the expenditure we've built some headroom, some space for these events. Although these costs might not come immediately to mind, whether that be extra dentist trips, medical presents, whatever, it's just about making sure that there is a buffer within the cash flow plan, so that if these surprises do occur, that they don't sink the plan. So number 5 is a mistake that I'm absolutely focused on, which is not considering unknown costs. Okay, next. So I talk on this channel a lot about risk. I just did it now when talking about the risk of inflation or investing too cautiously. And I've just mentioned there's a real benefit to make sure you're taking the right level of risk in retirement and having a very honest conversation with yourself, or ideally your planner, about what to expect and what you're comfortable with. The word risk, however, means very many things to different people. And I need to unpack what I'm referring to when I say take more risk. As that word often is used in the same context, it can lead to a very expensive mistake that can damage your retirement. So I just need to unpack some finance theory because it's crucial to understand this, so bear with me. In general, there are two types of risks we need to be aware of as an investor. They are compensated risks and uncompensated risks. And this is exactly as it sounds. As far as there are some risks which are in a generally efficient market, which is what you would expect if you've got a diversified investment, that you expect to get paid for. And then a risk like this is maybe investing more in equities than in bonds in an asset allocation. That increases what's called the equity risk premium. And for various reasons, because equities owners, they sit behind bondholders if a company goes under, they have what's called a lower debt seniority. For that reasons, equities are more volatile. And because no company is obliged to pay a dividend, that means when things go bad, equities normally go down in value more than bonds. Normally. Don't bring up 2022. Anyway, this is what's called compensated risk. You are getting paid for it. It's in exchange for more volatility and the price for additional returns. Now, what isn't a compensated risk is taking individual positions in stocks, because individual company fortunes are a bit random, frankly. Look at Enron, Lehman Brothers, Thomas Cook. These are individual companies that went to zero. And while the US and UK market continues to push forward, so the outcome can be very good or very bad on the individual stocks depending on luck. And in an efficient market, you don't get paid for taking the concentration. So if you hold an individual company as part of your retirement portfolio and you're not diversifying adequately, you're introducing an extra type of risk, which means that all the growth rates that are assumed are much less likely to pan out. And if you've got too much of those type of risks, they can destroy your retirement plan. Very simply, the stocks, diversified stocks could do really well, but the companies you picked could just blow up. And how I advise my clients when it comes to retire is, unless they're very wealthy, we do have to be mindful of removing uncompensated risks as much as we reasonably can, because you just don't have time to get steamrolled by a specific risk. Anyway, the best research out there is from a guy called Henrik Bessenbinder, who researched US and global stocks. In his 2017 paper, he researched the US market and found that since 1926, so ages ago, only 4% of stocks attributed to all the wealth creation above short-term treasury bills, which is considered a really low-risk returning asset, guaranteed by the US government. 58% of the stocks that were featured had returns less than treasury bills. So the key conclusion here is individual stock positions are very risky. The outcome is uncertain, and of course that could be good or bad. But when making financial decisions, there's always a gap between the decision quality and the outcome. And in retirement, because you've only got a limited amount of time to enjoy things and to get things right, I would argue you need to use all the tools at your disposal to make sure the gap between good decisions and good outcomes is as small as possible. And the way to do that is by using all the evidence in your favor, not against you. It'll be like building a health regime. You want all the evidence out there on diet and exercise, not to take a punt on an untested pill which may or may not work. So number 6 is too much concentration risk. Okay, the last one is the most common but probably the hardest one to get right. Now, if you look at any time in your life previously where you've succeeded, you've likely had a good idea of what you wanted to achieve. You've likely looked at the steps about how you were going to get there. Doesn't mean you had a crystal ball. It just meant you acted with intention. And the truth is, retirement planning is probably the most complex financial area someone will have in their entire life. There are multiple variables: spending, assets, goals, aspiration, tax. And all of this has to be wrapped in this complicated individual thing called human beings. And one thing I've started to notice more and more from my videos and contents of other people in the space is that I hope that through the education people like myself and all the rest of it offer, we can maybe get you 70 to 80% of the way there. But one of the things I'm hearing time and time again is I speak to people and say, I'm just worried that if I was to do it on my own, I'd make a mistake. And that's the ones that they've listened to a ton of content, they've got a really good idea of what they want to do, but they're just not confident enough to take action. And I actually completely get it. I feel the same with other areas of my life. If it's like a medical thing that's been nagging you, or maybe, I recently brought an accountant to help with something which is relatively simple. Because for me, the point of the risk of going it alone and being mostly right but actually wrong outweighed the benefit of just getting someone to help me. Because what a professional can do is they can show you the things that you don't know you're missing and just be very objective. But I say all of that though, but if you do it alone, it's really important you build your own financial plan. The reason why that's so powerful is it allows you to bring kind of the future into the present so you can do something about it now. There's no point getting to retirement and going, oh no, I've undersaved. But also it can actually be the case with some clients that I speak to that we have almost a bit of a bittersweet moment where I go, okay, it's not only the case that you can actually retire, but you probably could have retired 2 years ago. Now, for the people who are desperate to retire, I believe that's a bit of a tragedy. No one knows how long we've got. And the benefit of having a plan means that you can adapt as you go. So yes, number 7 is probably the most important mistake, is just having no financial plan. And I hope to see you next time. Thanks.